In this presentation, we will discuss funding for education, saving strategies, and products. By the end of this lesson, you should be able to discuss the process of planning for educational need, explain 529 plans, Coverdell ESAs, and custodial accounts that can help a family accumulate assets for future educational needs. Educational funding is a daunting challenge for many parents, especially when you consider the fact that the growth rate of college tuition is growing faster than the overall cost of living. Families face serious cash flow constraints, and there might be several children to put through college. In this lesson, you will learn about savings strategies and products that are effective for long-term investment time horizons, when the magic of compounding and tax-advantaged investing kicks in. In another lecture, you will learn options for those clients, those families facing short-term time constraints. Funding need analysis is a logical process. You need to determine how long the child has until the start of higher education and what the projected annual costs will be. The costs that you need to consider include tuition at the school of preference, books, room and board, travel, and miscellaneous items. While you can research what these costs would be in today's dollars, you'll need to apply reasonable tuition and cost of inflation assumptions to calculate the future dollars. Next, you should ask your client, how much of that cost do you feel responsible for? Some clients believe that the child will have a greater investment in learning if she or he is participating in the payments. Knowing those valuable inputs, you can calculate contribution requirements based on different schools or types of schools, college start dates, and projected investment returns. Once you have run the different scenarios and projected different contribution alternatives, you will present it to your client for approval. Note that in this course, you do not cover time value of money, a core concept needed to complete this needs analysis. You will thoroughly learn time value of money in Cal Lutheran's Financial Principles and Policy course and in the Investments and Portfolio Management course. As you can see from this list, Congress has provided a number of tax-advantaged funding methods in order to encourage saving for education, including savings bonds, the Coverdell ESA, the 529 prepaid tuition plan, and the 529 savings plan. Additionally, there are various taxable strategies for funding education. These strategies include the custodial accounts, UGMA and UTMA, Trust for Minors, 2503B, 2503C, and taxable investment accounts. Your job is to match the client with the right strategy or product and to educate them on the importance of starting early. Let's look at these alternatives. U.S. Savings Bond, Series EE and Series I are low-risk investment vehicles that some clients may want to use for educational funding. The bonds are purchased at a discount to face value, interest is tax deferred until time of redemption, and interest earnings are tax-free if used to pay for qualified tuition and fees. Note that there is a AGI phase-out, therefore the tax-free benefit may not apply for higher income families. When the parent is the owner of the bond, the value of the savings bond is not directly counted against the child for purposes of determining financial aid. Savings bonds can be purchased through a commercial bank, a Federal Reserve Bank, or savings bonds direct. The Coverdell Educational Savings Account, formerly known as the Educational IRA, shares a lot of similarities with Roth IRAs. First, there's a limit to the annual contribution. This annual limit is currently $2,000 for each beneficiary, regardless of the number of contributors or accounts. For example, one parent could contribute the full $2,000 annual contribution or a parent and 3 relatives together could contribute smaller amounts that in aggregate add up to the maximum $2,000 annual contribution. Second, there are contributor phase-out limits based on adjusted gross income. That means a potential contributor is not allowed to make a contribution if his or her adjusted gross income exceeds the phased-out amount. Third, the contributions accumulate on a tax-free basis. You can imagine the compound growth that might occur if the child has 10 or 15 years until the start of college. The Coverdell withdrawal is tax-free if used for qualified educational purposes in that year. Withdrawals can be used to pay for tuition and fees at primary, secondary, or higher education institutions. If the funds are not needed by the child, the entire Coverdell ESA can be rolled over to the educational savings account of another family member. However, the rollover needs to be completed by the time the beneficiary reaches age 30. Note that the contributor does not get to deduct the amount of his or her contribution to the Coverdell when calculating his or her federal tax liability. 529 college plans are qualified tuition plans that are very popular and for good reason. They offer the tax-deferred accumulation of income and capital gains, and withdrawals are tax-free if used to pay for qualified educational expenses. As a general rule, the 529 account can be opened by anyone over the age of 18. In some cases, you need to be a resident of the state. However, residency is not always a requirement. When opening up the account, you name a beneficiary. Typically, that's the future student. And if needs change along the way, you have the ability of changing the beneficiary to another family member. For example, maybe to your daughter or a cousin, a niece, a grandson. Contributions are considered to be a gift of present interest. Therefore, they're eligible for the annual gift tax exclusion. A valuable attribute of the 529 plan is that a contributor to the plan could place a lump sum equal to 5 years of annual gift tax exclusion amounts without a gift tax implication. For example, assuming that the annual gift tax exclusion is $14,000 a year, then the person could contribute $70,000 into the plan today. That person would not be eligible to make another contribution without gift tax implications until 6 years from that date of the contribution. The contribution to the 529 is not tax deductible for income tax purposes. However, some states allow them to be deducted on the state income tax return. 529 college plans are administered either by the state or individual university. The administrator establishes the rules, including the types of investments that can be offered, the aggregate contribution limits, participation rules, etc. The administrator in turn selects a plan manager, which is typically a mutual investment company. That investment company handles the paperwork, the investment portfolios, and the reporting requirements. There are 2 types of 529 college plans: the prepaid tuition plan and the savings plan. The 529 prepaid tuition plan allows the participant to lock in tuition rates in today's prices. That means that the state or the individual school guarantees that the growth rate on your investment will match the inflationary rate of tuition. For example, if the current year cost of tuition is $10,000 and you contribute $10,000 today, then you will receive 100% of annual unit, or 1 year of education down the road. On the other hand, if the college costs $20,000, you contribute the $10,000, then you receive 50% of annual unit, or 6 months worth of schooling. Do you see how the contribution buys you a unit of education in the future? The prepaid tuition plan works best when you can target an individual school or a limited group of schools. If the child decides to go elsewhere, the plan can be transferred. Unfortunately, the transferred assets might not cover the full cost of tuition at the new institution. One drawback with this plan is that every dollar that goes into that tuition decreases the student's eligibility for financial aid. The 529 College Savings Plan is sponsored by the individual state. While the prepaid plan works well if you know exactly where your child is going to go, the saving plan works well when you want to leave options open. Assets in the plan can be used to pay undergraduate or graduate expenses at any accredited educational institution in the U.S. or abroad. There's a wide range of investment alternatives, although it is still restricted to funds and choices offered by the mutual fund administrator. There are numerous benefits to the plan, including interest, dividends, and capital gains, built up on a tax-deferred basis, and withdrawals will be tax-free if used for qualified higher education expenses. Assets are considered to be that of the owner, not the beneficiary, and that can help if the child plans on applying for financial aid. There's higher annual contribution limits, particularly when compared to the covenant. An unlimited number of accounts for the same beneficiary can be opened. Contributions to the 529 can be sheltered by gift tax by using the annual gift tax exclusion, and possibly there could be state income tax write-offs. The custodial account is often used as a receptacle for gifted money. A parent or a grandparent might want to use their annual gift tax exclusion to transfer money to a child or a grandchild. Rather than going through the expense and complexity of setting up a customized trust, they simply call a financial institution, obtain the custodial account paperwork, and fund the custodial account. There are a couple drawbacks that offset the benefit of this inexpensive setup. Assets in the account are considered to be an irrevocable gift and therefore the property of the child. That can affect the child's ability to get financial aid or possibly scholarships in the future. Income and capital gains earned on custodial account assets are subject to the kiddie tax. What that means is that only a small amount of income is taxed at the child's rate. After that cap amount is reached, all income is taxed at the parent's marginal rate. You'll learn more about this in your tax management and strategies course. Assets have to be turned over to the child when they reach majority. That's either age 18 or 21, based on the custodial account agreement. That means the child could end up using the funds that were intended for educational funding for other activities. There are two basic types of custodial accounts, the UGMA account and the UTMA account. The Uniform Gift to Minors Act, or UGMA, is a custodial account subject to state laws. The parent or the guardian is typically the custodian. The UGMA can hold cash, securities such as mutual funds, individual stocks or bonds, and insurance. The child has to be given the right of possession at age 18 or 21, depending on state law. As discussed, account income and gains are taxed at the kiddie rate. The Uniform Transfers to Minors Act, or UTMA, is quite similar to that UGMA. The primary difference is in regards to the assets that are allowed into the account. As listed on the slide, you can see that there's a broader range of permitted assets, including cash, securities, insurance, real estate, limited partnerships, even family business assets. As also note that the assets are generally required to be distributed to the child once he or she reaches age 21. The 2503C trust and the Crummy Trust allow for a transfer of assets that still qualify under the annual gift tax exclusion. General characteristics of these trust arrangements include They offer greater control of assets than the UGMA and the UTMA custodial accounts. Control over use of the funds is not necessarily required when the child reaches age of majority, whether that's 18 or 21. Income from assets may be taxed at the trust rate rather than subject to the kiddie tax, and these assets may affect the ability to obtain scholarships or financial assistance in the future. The 2503C Minors Trust is established when the irrevocable gift is transferred. The value of this trust is included in the child's estate. Therefore, as mentioned, it can affect that child's ability for those scholarships or financial aid. The assets in the trust are managed by the trustee until the child reaches the legal age of 21. At that time, assets are turned over. Prior to the child reaching that age 21, the trustee has discretionary authority to use income and corpus for the benefit of the child. The Crummy Invasion Trust offers control and discretion about when to distribute assets to the child. And the contributor can still make advantage of the annual gift tax exclusion. This occurs because the child is given the discretion of whether or not to take the contribution rather than placing it in the trust. You'll learn a lot more about the concept of crummy trust in your Principles of Estate Planning course. Note that the contribution to the trust is an irrevocable action. Therefore, the trust becomes part of the child's estate. As we've already discussed, this has implications on future access to financial aid and possibly scholarships. There are several other taxable strategies that might be used to save for education. The zero coupon bond. The zero coupon bond is an excellent alternative because it perfectly matches the asset and the liability. For example, knowing that your child will start school in 5 years, you could buy a zero coupon bond that matures in 5 years. For that matter, you could ladder 4 bonds so that they mature in 5, 6, 7, and 8 years, respectively. The laddering strategy respectively matches the start of the 4 school years. Because the bond matures on the exact date you need it, there isn't a problem with interest rate risk, which would impact the value of the bond that isn't maturing on that date. This instrument is a discount bond that pays no interest until maturity. For example, you might pay $500 today for a bond that matures in 5 years and returns $700. During those 5 years, you receive no interest. Unfortunately, you do have to pay tax on the interest that accrues during the years. Unless, of course, you purchase the zero coupon bond inside a tax deferred account. The Treasury Inflation Protected Security, or known as the TIP, are issued by the U.S. government, and they provide an element of stability and inflation protection to your client's educational savings portfolio. This security pays a fixed interest rate on the principal amount, which is adjusted each period for inflation. The principal adjustment is not paid out until the bond matures. Taxable investment accounts. One of the benefits of saving for education in a taxable investment account is flexibility. There's no future tax and penalty consequence if assets are not used to fund education. Moreover, the account holder may have access to a broader spectrum of investment instruments, including options, managed futures, and private investments. While not designed for this specific purpose, some clients will tap the cash value of their life insurance and balances in their individual retirement accounts to help fund education. As you'll learn in your risk management and insurance class, the cash value of permanent life insurance can be borrowed and later repaid. While access to the funds offer flexibility, it's important to plan for that repayment. Otherwise, there are meaningful tax consequences, including a penalty for early withdrawal. Traditional and Roth IRAs offer 2 other possibilities. Before tapping these resources, it's important to reflect on 2 issues. One, you can borrow funds for education, but you typically can't borrow to fund retirement needs. And two, early withdrawals from retirement accounts occur an ordinary tax liability and a 10% early withdrawal penalty if some of those, and that will kick in if some of those withdrawals are not used for qualified educational expenses. You will learn more about withdrawals from retirement accounts during your employee benefits and retirement planning course. Note that withdrawals from a Roth IRA, subject to some restrictions, are deemed to be the withdrawal of principal first, which is not taxable. In this lesson, you learned about the process of planning for educational savings, tax advantage educational saving vehicles, gifted, custodial, and trust accounts, and other taxable saving strategies and products.